joining us right now. You know, folks, it's like I'm chopped liver. I mean, it's all there is to it. It's Paul Sweeney and Tom Keene. And we are after her conversation with the legend, Kenny Polcari, over at the New York Stock Exchange. That's trader talk.
That was yesterday.
Okay, what do you say to Ken Polcari that you don't say to me? I mean, that's like in and out of the market, right?
Yeah, look, it is a good reminder that there's all these short-term movements in markets that are driving the volatility that we're experiencing, but you have to keep the long-term in mind, which is why we've been continuously saying to clients, it's not where the S&P 500 ends at the end of this year. It's what you do with the volatility along the way.
Are traders getting slammed as a general statement? I mean, trying to game this market right now? Is anybody making money?
Well, we've certainly seen traders move from being max long equities at the beginning of this year, 98th percentile kind of positioning, to that's now fallen to the 26th percentile.
Yeah.
Wow,
So
really?
There's probably been some pain along the way.
Polcari looks like out of Central Casting, Game of Thrones or Outlander or one of those things. I mean, is he retired?
No, he's trucking.
He's trucking. Okay. So good morning to Ken Polcari and everybody down at the New York Stock
Salomon
Exchange.
Brothers guy back in the day. Your note is the end of U.S. exceptionalism. Is it the end of U.S. exceptionalism, or do we still have room to grow? What do you think?
So what we wrote about is this idea is that it's very easy to ascribe a narrative to price action. Everybody looks at the weakness in the U.S. dollar year to date. They look at the outperformance of Europe versus the rest of the U.S. and they say it must be the end of U.S. exceptionalism. But if you look, it really is a function of the fact that we started the year with a massive, very, very crowded dollar long position that has since been unwound. Traders are now slightly short the dollar.
Is that right?
And we actually think that you could see some dollar stability here now that you've burned off all of that crowded positioning.
Interesting. So what do we, I mean, when you talk to your clients here, again, we had that peak to trough drawdown in the S&P 500 of about 10%. Do they view that as a healthy pullback in an otherwise positive market, or is it something else?
We'd hope that we've talked to clients enough and set up the potential for volatility that there is a degree of calm when we see it. We often talk that volatility is a feature of being an equity investor and that we should see it as opportunity. Now, we think the other reason why there's been this calm is that if you look at a 70-30 portfolio for ACWI, so that's an international balanced portfolio, including the U.S. and the ag, you're still up on the year. So yes, we've seen the U.S. stock market pull in, but at the end of the day, it's not been cataclysmic.
Are we getting used to, I asked Michael Dart, I alluded to this with Michael Dart, more directly with Cam Dawson. Are we needing to slot in the understanding that equities are a single-digit return in our double-digit return addiction?
Yeah, I think that that's very, very likely, is that we've been in this world of very strong double-digit returns the last 2 years. Investors got conditioned to expecting that, which is why you saw these estimates for 7,000 plus in the S&P 500. That's very hard to do when you start the year at 22.6 times forward earnings. You start the year at the 90th percentile of positioning. So our best case scenario for 2025 is that you get growth, upside that's equivalent to earnings growth. Okay. But that assumes that multiples stay constant. And we're not sure if you get multiples staying constant in a world where you're cutting earnings estimates and there's some risk off flavor.
How about Europe? Europe's had a heck of a start to the year here. And that story we had heard kind of last year where European and international money coming into the U.S. market had a little bit of a reversal of that. How do you think about the performance of the European equities?
We do think that the easy part is over for European equities. You started at 13.5 times forward. Now you're trading at 15 times. Okay. 15 times doesn't seem like a lot when you compare it to the 20 times in the U.S., but it is the high of the valuation range and the pre-pandemic range for Europe. So it really comes down to earnings delivering. Quite interestingly, earnings for Europe have continuously been getting cut, even as we've been seeing this rally. So it's a show me story.
Right now, the Show Me Story is Cameron Dawson with us this morning with NewEdge Wealth. We welcome all of you in your commute across the nation. Good morning, 92.9 FM in Boston, 99.1 FM in Washington, Bloomberg 1130 in New York. An ample conversation with Cam Dawson on YouTube. Subscribe to Bloomberg Podcasts. Even Cam Dawson subscribes. It's just
tech savvy.
Put us up to 42 is amazing.
Exactly. You know, I'm looking at the relative strength index, the RSI on the Bloomberg terminal for the S&P 500. Man, we kind of bottomed back just like 10 days ago, but now we're moving higher here. I mean, how do these technicals feel? It feels like is the sell-off, are we done with the sell-off here? Or how do you think about it?
So we certainly got oversold enough to bounce, which is why we think we're bouncing today and yesterday. What the question is, what happens when you hit resistance? And are you having enough momentum to break through that wall of resistance, which we think is around the 5,900, 6,000 level? That's your downward sloping 50-day moving average. You've been losing momentum in this market really for the last 9 months. If you look at things like a weekly MACD. So we do think that this is an environment that you could roll at resistance.
I'm going to go right there because I hate it. I'm not a MACD fan, folks. We won't go into the nuances of it. 1600 Pennsylvania is not looking at the weekly MACD.
No.
I mean, they're not. The bottom line is we can't lift until we get political clarity, right?
Exactly. Why would we trade back up to all-time highs when we've cut earnings estimates since, and we have valuations that would have to go to new highs to get there, which is why we think this year at best is that wide, choppy range because of the degree of uncertainty and because of the potential downsides to growth.
It's depressing. Mag 7, are they still the Mag 7, even ex-Tesla?
We've been raising the question if they're more like the Lag 7. We talked, I think, last week.
Do you see a lessening of their cash flow, free cash flow?
It is happening because of the big uptick within CapEx. You are seeing free cash flow margins come in. Now, these free cash flow margins are still so much better than you can get in the rest of the market.
Exactly.
Yep.
So do they become a safe haven when people have questions about growth other places? Very possibly. The valuations aren't as stretched as they are, but the market cares about second derivatives. The market cares about the slowdown in earnings growth, which is inevitable when they had such massive earnings growth over the past 2 years.
But you said the free cash flow will sustain even if earnings come down.
But it is.
I mean, Zuckerberg's going to manage the P&L statement, right?
And they're sitting on massive, huge cash balances as well that they could deploy to repurchase shares.
So are they the new Dominion Electric? You're too young to know that. Could you get me someone in here older that actually knows what D is? Are they the new utility?
That is an interesting question. If they become such monopolized businesses that they are effective utilities, then it raises the question of, do they get regulated like utilities do? And do we see those free cash flow margins compress over time because of the fact that they act like utilities?
I mean, Paul, you're the only one that stand in this building that knows what Florida Power and Light is.
Dominion Energy, based in Richmond, Virginia, home of the
It
Richmond
was.
Spiders.
Look at that dividend growth.
Exactly. Earnings are important for this market because I'm not sure the Fed's going to give us a whole lot this year. Maybe one, maybe two rate cuts. So that puts even more pressure on earnings story. And you mentioned that earnings estimates have been coming down. How risky are the numbers that are out there, do you think?
So we think the biggest risk is possibly within financials. So you've been seeing every sector get cut. Financials have seen less earnings revisions lower, but think about the setup for financials coming out of the election. People said a steeper yield curve, we're getting M&A, we're getting IPOs, we're getting deregulation. We've gotten none of that. So we do wonder if that's an area of risk going into first quarter earnings.
Okay, Shanghai, China. Good morning, good evening, I should say. Shanghai, China this morning, listening in. Is China the opportunity Sophia Drosis and Mike Darda were talking about?
Well, China certainly has that valuation opportunity where it still trades at such a huge discount to the U.S. It's underloved. It's been called uninvestable.
So are you going back to a textbook 8, 9, 12, 10% allocation to international?
So we are neutral international. We said you just can't ignore the degree of outperformance in the U.S., underperformance in international, but we don't see signs yet that justifies going to an overweight position.
What are we doing in fixed income here? My 2-year treasury is now back above 4%. Do I stay there? Do I take some credit risk? Where do I go?
So we don't think, again, that you're getting compensated for mostly high yield credit risk. So we moved to reduce some positioning within high yield just to say, let's ride out some of the equity volatility, but we want to be able to take some risk out of portfolios in the event that these growth fears do come to pass.
So in the equity space, what screens well for you guys these days?
So we are finding lots of opportunities within international markets, but very selectively in that the big, beautiful quality world. We're finding opportunities within mid caps as well, and then value, lots of opportunities where you still see areas of the market that trade at discounts, that have good free cash flows, have good balance sheets, and it's just maintaining that valuation discipline, which we think is absolutely critical at this point.
What's the key attribute of those opportunities?
The key attribute is that they are not trading at stretch valuations, and they have stable earnings through cycles, and they have good free cash flow that is potentially seeing better free cash flow margins. So it's about being very picky. We think that there's a big divergence between the winners and the losers in this kind of environment.
This guy in Shanghai, it's child abuse. He's got his 4-year-olds watching it. Look at that in Shanghai. Can you see it, folks?
Yeah.
That's cruel and unusual punishment.
Watching surveillance in the morning.
Full
Or the
disclosure,
evening, I
folks,
guess.
it's my grandchildren. We say good morning to the Rugrats in Shanghai this morning. But, getting back to the international and Pacific Rim, I got too much gloom out there. I got guest after guest read me the Uncertainty Act. It clears at some point. How do you prepare for the moment where the uncertainty drifts away?
Well, I don't think that you can wait for necessarily confirmation from the data. The important things is that price will lead the data. And so as we're starting to see some of these turns and trends, we have to be there, which is why we moved to a neutral position within international about a year ago, saying it's going to happen, maybe this time.
So is our Federal Reserve going to help us this year, or are you still kind of
That's
saying
the key question.
a couple of cuts here?
All
maybe?
this talk, folks, Sweeney just asked the money question.
We're not counting on the Fed for anything. We don't think that the labor market is going to be weak enough to justify them cutting. We don't think that inflation is going to move down fast enough to give them the degrees of freedom to cut, which means that get used to these higher for longer rates. And that's why we think that you have this continuous pressure on weak balance sheet companies that you should fade any strength.
So
in those
what's your
names.
money unemployment rate?
So we don't think that the Fed will cut unless we see mid fours on the unemployment rate.
4.5, 4.6.
4.4, 4.5.
Really? Wow.
is
Come on, it's not that far away.
It's not that far away, but we don't see this sharp deterioration in the labor market happening at this point. Yes, we see the sentiment around labor deteriorating, but we've not seen companies move to full force layoffs that just suggest that there still is that underlying stability for now.
Yeah. So, I mean, it's interesting. I mean, one of the questions is, I think for a lot of people is, do I take this pullback to buy stocks here, or is there just more uncertainty out there because it's just one tweet away from another pullback in the market?
If you're buying stocks because you think it's going to be a V-shaped recovery and it's up and to the right with low volatility, it's the wrong move. But if you're buying stocks to say, I'm going to own this for a long time, I'll step into volatility, we think you can still buy weakness.